Alright, my name is Brandon Locker, and today I'm going to be talking about Federal Reserve money supply and interest rates. So what is the Federal Reserve? It was founded by Congress in 1913 under the Federal Reserve Act. It's not subject to oversight by Congress. They do have a little bit of say in what the Federal Reserve can and cannot do, but the oversight is very limited. And their decisions don't have to be ratified by Congress or the President. There's 12 main districts. Each has its own main Federal Reserve Bank. As you can see on the chart, some of the big ones, San Francisco, New York, our local ones, Cleveland. Each bank operates under its own general supervision and under the supervision of a board of governors. The Federal Reserve System banks actually own the 12 district banks. So every Federal Reserve Bank in each of these districts owns these district banks here, essentially. There's 7 members of the board that are headquartered in D.C., and the President actually appoints these individuals, and then the Senate confirms these members. The Federal Open Market Committee, the FOMC, is made up of the 7 members of the Board of Governors, but it's also made up of the President of the New York Federal Reserve Bank and 4 presidents of the other Federal Reserve Banks rotating on a basis. And then monetary policy, making body of the Federal Reserve System is the FOMC. And what they try to do is they try to promote full employment, economic growth, price stability, and sustainable trade. Maintaining financial stability is also another key component of the Federal Reserve. Some of the things that they try to do are like mitigate inflation and to keep the unemployment rate low. The FOMC actually sets guidelines on where they want these rates to be. They want inflation to stay right around 2%, and they want to maintain employment between 4.2 and 4.8%. This is what they consider full employment at this point in time. An adjustment to the Federal Reserve rate, which is going to be the federal funds rate, can actually cause some major adjustments in the market and in the money supply. But some of the effects on inflation is if the federal funds rate is reduced, it increases the demand for services and goods, which leads to higher wages and higher demand for employment, as well for supplies from distributors. In 2008, the rates were near 0%. So whenever the market crashed, the Federal Reserve actually had to make non-traditional monetary policy changes in order to try to mitigate the impact of the housing bubble bursting. And also on the money supply side of things, the money supply is the amount of currency held by the public and by transaction depository institutions. This is believed to be an indicator of future prices and of inflation. However, it's become less viable lately. In the last decade or so, it's become so much unreliable that people have started to just mitigate away from it and only use it to see how much money is actually in the market and don't use it to guess where our inflation's heading or what prices and GDP are going to be. The money supply basically comes from a central bank of the Federal Reserve System. So each of these districts is the money supply to all of the district banks. And then these banks, which are depository institutions and financial intermediaries, have depositors and individuals and other banking institutions on the public side that use this money in order to make purchases, give out loans, etc. Monetary base is the Fed can control market operations. However, it cannot determine the amount that banks borrow. This amount is going to be determined based upon how much the demand is for funds. So if there's lower interest rates, more people are going to be applying for loans, so the banks are going to demand more money, and therefore the Fed has to push out more money and increase the money supply. Here's a little table to kind of show what some of the changes can do. If the Federal Reserve System was to increase non-borrowed monetary base, then the money supply would increase because they're putting more money into the market. However, if they increase the required reserve ratio, which is the amount of money these banks have to hold on hand in case anybody comes in and wants their deposits or if there's a run on the markets, this is going to lower the money supply because these banks have to hold more but can't loan as much. If the banks were to increase their borrowed reserves, this increases the money supply because they have more money and they're willing to loan it at lower interest rates. And if they have excess reserves, it's going to lower the money supply because they have more money sitting in the banks that's not being out in the market. In depositors, if they increase how much money they're holding on themselves and not depositing as much, they're actually going to decrease the money supply because it's going to be less money that's technically in the market and accounted for. The discount rate of interest rates on loans made by the Federal Reserve Banks is known as the federal funds rate, which if raised or lowered, tightens monetary conditions or lowering expands monetary conditions. This is what could have been used in 2008 if we would have had a higher interest rate, but we were already near 0%, so like I said, the Federal Reserve had to use non-traditional payments and tools. But like I said, this can be used as a monetary expansion tool and can be used to lower inflation and things during a recession. In conclusion, the Federal Reserve controls major aspects of financial markets and controls a lot of what goes on in the money supply and in our economy, and based upon what they decide to do with the inflation rate, what they want to do with their interest rates, they can adjust, like I said, inflation, unemployment, and demand and prices in the market. And the money supply is also dependent upon Federal Reserve's choices based upon how much they want the required rate to be and how much they think that these banks should be holding in order to mitigate a run on the markets and pardon me, in order to make sure that something like the Great Recession doesn't happen again. And these are my sources. Thank you.